Welcome back to the Daily Crypto Deep Dive. For years, crypto investors have been told one simple story. Interest rates will eventually come down, money will become cheaper, liquidity will return to the system, and Bitcoin will benefit. But what happens if that story is wrong? What happens if the Federal Reserve does not cut interest rates at all? And more importantly, what happens if the Fed actually starts raising them again? That possibility is no longer some distant theoretical risk. It is now being openly discussed by Federal Reserve officials. Financial markets are actively pricing it in. Inflation remains well above target. And some analysts believe the United States could see multiple additional rate increases before the end of 2026. So today, we are going to explain exactly why interest rates could be going higher, why inflation refuses to disappear, what the war with Iran and the Strait of Hormuz have to do with your crypto portfolio, why Bitcoin cares so much about the decisions made by a group of central bankers in Washington, and most importantly, what could actually happen to Bitcoin prices if rates rise again. Because whether you like central banks or hate them, whether you believe Bitcoin was created to escape them or not, there is one uncomfortable truth. Right now, the Federal Reserve can still move the Bitcoin market. The Federal Reserve's benchmark interest rate currently sits between 3.5% and 3.75%. The next major piece of the puzzle arrives with the June inflation report, followed by the next Federal Reserve meeting on July 28th and 29th. And suddenly, the possibility of another rate hike is very real. Federal Reserve Governor Christopher Waller has warned that if the latest core inflation data shows another hot reading, the Fed may need to consider tightening monetary policy in the near term. Markets responded immediately. During Waller's remarks, expectations for a July rate increase jumped, with rate futures pricing in as much as a 45% probability of a hike at the July meeting. Traders now see very strong odds of higher rates by September. And before we get into exactly why that matters for Bitcoin, remember that anyone who signs up to Kraken through our link and completes the required steps can receive 20 XRP from us as part of our listener promotion. Full details are in the episode description. Now, to understand why the Federal Reserve might raise rates, we first need to understand what it is actually trying to do. The Fed has two major jobs: maintaining maximum employment and keeping inflation under control, with a long-term inflation target of 2%. Inflation, however, is still far too high. In May, headline US inflation was running at 4.2% annually. Core inflation, which strips out food and energy because they can be especially volatile, was running at 3.4%. That alone is a problem. But what concerns people like Waller even more is that inflation appears to be broadening throughout the economy. According to his analysis, almost 70% of categories within core services were experiencing inflation above 3% on both a 3-month and 12-month basis. That is important because the Fed can sometimes look through a temporary spike in one particular area. If the price of oil jumps for a few weeks because of a war, the Fed does not necessarily need to immediately raise interest rates. But if prices are rising across rent, insurance, healthcare, services, wages, and other parts of the economy, that starts to look much more persistent. And persistent inflation is exactly what the Federal Reserve fears. Then we have the Iran conflict and the Strait of Hormuz. A significant amount of the world's oil passes through this narrow waterway. If shipping is disrupted, oil prices can rise. Higher oil prices increase transport costs. Businesses then pay more to move goods. Airlines pay more for fuel. Factories pay more for energy. Consumers pay more at petrol stations. Those increased costs can gradually work their way through the entire economy. And the Fed faces an extremely difficult problem. It cannot produce more oil. It cannot end a war. It cannot reopen a shipping route. The main weapon it has is interest rates. By raising interest rates, the Fed makes borrowing more expensive. Mortgages become more costly. Car loans become more expensive. Business financing becomes harder. Credit card debt becomes more painful. Companies may invest less, consumers may spend less, and overall demand in the economy can cool. That sounds brutal because frankly, it is. The idea is essentially to slow the economy enough that businesses lose some of their ability to keep increasing prices. But now we get to the important question for this podcast. Why does any of this affect Bitcoin? Bitcoin does not have a central bank. It does not pay interest. There will never be more than 21 million Bitcoin. Jerome Powell, Kevin Warsh, or any future Federal Reserve chair cannot simply create more of it. So why should Bitcoin care whether US interest rates are 3%, 4%, or 5%? The answer is opportunity cost and liquidity. Imagine US government debt is paying you a relatively high return with very little perceived credit risk. Suddenly, investors have a serious alternative to holding volatile assets. Why take enormous risk chasing returns in Bitcoin, technology stocks, or speculative assets when cash and short-term government bonds are providing attractive yields? Higher rates make safe assets more competitive. They also make borrowing more expensive. Hedge funds have less access to cheap leverage. Companies find it harder to borrow. Investors become more cautious. Financial conditions tighten, and less speculative capital is available to chase assets like Bitcoin. That does not mean every interest rate hike automatically causes Bitcoin to crash. Markets are far more complicated than that. But the basic mechanism is clear. Higher rates tend to remove liquidity and increase the attractiveness of safer yield-bearing assets, while lower rates tend to make risk-taking more attractive and can encourage capital to move further out along the risk curve. There is another extremely important point. Markets usually react to expectations before the actual decision happens. Bitcoin does not necessarily wait until the Federal Reserve officially raises rates before falling. If traders suddenly believe a rate hike is coming, Treasury yields can rise, the dollar can strengthen, financial conditions can tighten, and risk assets can react immediately. Recent academic research analyzing more than 118,000 market messages found that hawkish central bank narratives consistently produce negative reactions in Bitcoin, independent of whether an actual interest rate change had already happened. In other words, sometimes the threat matters almost as much as the action. And we are seeing that now. Bitcoin has been trading around the low $60,000, far below its previous record highs, while markets contend with inflation, geopolitical uncertainty, weak institutional demand, and the possibility of tighter Federal Reserve policy. One widely followed analyst, Dr. Profit, believes Bitcoin has been forming a large bear flag pattern. His initial downside target is between $54,000 and $56,000, followed potentially by a deeper move toward the $40,000 to $50,000 region. Options traders have also shown interest in downside protection around $52,000. But this is absolutely not a certainty. Chart patterns are subjective, and analysts can look at exactly the same chart and come to completely different conclusions. And that disagreement becomes even more obvious when we look at the interest rate outlook itself. Bank of America has taken one of the most hawkish positions, forecasting 3/4-point Federal Reserve rate hikes during 2026. Its argument is that the American economy remains relatively healthy, the labor market has held up, and inflation risks are being underestimated. But Neuberger Berman has taken almost the opposite position. Portfolio manager Joseph Pertel believes current market pricing for 1 or 2 additional rate increases is excessive and expects the Fed to remain on hold well into next year. Citi's Jason Williams has also argued that markets may be pricing inflation as too persistent. His view is that if the Fed simply does nothing, Treasury yields could fall significantly as traders unwind their bets on future rate increases. And this disagreement is crucial for Bitcoin, because there are 3 broad scenarios from here. The first is the bearish scenario. Inflation remains hot. Oil prices stay elevated. The Iran conflict continues. The Federal Reserve raises rates, perhaps more than once. Treasury yields remain high. The dollar stays strong, and liquidity remains tight. In that world, Bitcoin could struggle to attract enough new capital for a sustained rally. A retest of $60,000 would become increasingly likely, followed potentially by $54,000 to $56,000 if that support fails. A more severe risk-off event could potentially push Bitcoin into the $40,000, although there is absolutely no guarantee that happens. The second scenario is probably the most frustrating one. The Fed does not raise rates aggressively, but it also does not cut them. Inflation remains too high for easing, but not high enough to justify a dramatic tightening cycle. Rates stay higher for longer. Bitcoin remains trapped in a broad range, periodically rallying on good news before being pulled back by weak liquidity, high bond yields, or another macroeconomic shock. That could mean months of frustrating sideways price action. Then we have the bullish scenario. Inflation begins to fall. Oil prices settle. The Fed decides the market has become too pessimistic. Rate hike expectations disappear. Treasury yields fall, the dollar weakens, financial conditions ease, ETF inflows return, and capital begins moving back toward risk assets. Bitcoin would not even need an immediate rate cut for that to be bullish. Simply removing the threat of further hikes could be enough to change sentiment. This is why the next few inflation reports matter so much. And it is also why listeners should be careful with anyone who makes absolute predictions. Nobody knows precisely where Bitcoin will be in 3 months. A recent review of cryptocurrency forecasting research found that no peer-reviewed model has consistently demonstrated an ability to beat a simple current price baseline across different market regimes over 1 to 6 month periods. That is a complicated way of saying something very simple. Predicting Bitcoin is difficult. So our own view is not that Bitcoin is definitely heading to $50,000, and it is not that the next rally is guaranteed to begin tomorrow. Our view is that interest rates have once again become one of the most important forces in this market. The most bearish development would not simply be 1 quarter-point hike. It would be evidence that inflation is accelerating again and that the Fed needs to begin a genuine new tightening cycle. The most bullish development may not even be a rate cut. It could simply be evidence that inflation is cooling enough to kill the rate hike threat completely. And somewhere between those two outcomes is where the next major Bitcoin move could be decided. If you hold your own crypto, remember that a hardware wallet such as Ledger allows you to keep control of your private keys, rather than leaving everything permanently exposed on an exchange. The bigger story here is that Bitcoin was created as an alternative to the traditional monetary system, but it still exists within a world dominated by dollars, bonds, banks, interest rates, and global capital flows. One day, perhaps that relationship changes. But today, when the Federal Reserve tightens financial conditions, Bitcoin feels it. When Treasury yields rise, Bitcoin feels it. When investors can earn attractive yields without taking Bitcoin-level volatility, Bitcoin feels it. And when expectations suddenly change from rate cuts to possible rate hikes, Bitcoin absolutely feels it. So over the coming weeks, forget simply staring at the Bitcoin chart every 5 minutes. Watch inflation, watch oil, watch Treasury yields. Watch what Federal Reserve officials are saying. And most importantly, watch whether the market begins pricing even more rate hikes or starts removing them. Because the next major move in Bitcoin may not begin with a whale buying billions of dollars of crypto. It may begin with one inflation number in Washington. Thank you for listening to Crypto News Today. Let us know in the comments what you think happens next. Does the Federal Reserve raise interest rates again, or is the market becoming too pessimistic? Take care, stay safe, and we will see you at the top.